Okay, there's one rule I never break when I'm buying industrial real estate. I know it's common sense, but the deal has to cash flow from day one, especially in 2026. Not after month 6, not after you fully lease it up, the first day you acquire the asset. No hope, no projections, not if rents grow to a certain point, then I'll make a return. And in this video, the key point I want to talk about is positive leverage. This is what protects investors right now in industrial real estate investing. Most real estate investors have heard the term leverage, but positive leverage is something different. So positive leverage just means that the cap rate on what you're buying is higher than the interest rate of what you're borrowing. This is the spread. This is the gap. This is the day one margin of safety that you protect the downside. It means that the asset is producing more income than it costs to finance. And that's before you do anything to the asset, before rents grow, and before you improve a single unit. This way you ensure the deal works right out of the get-go. This is the foundation of real estate investing that we'll build on. All right, so let's do some live deal math. I'm gonna show you what positive leverage actually looks like. So I was in Houston last weekend acquiring $30 million of assets, small bay industrial, and what I'm focused on is what is the stabilized yield to cost, meaning the cap rate after I buy it, after I put in the capital expenditures, the improvements, meaning paving, painting, lighting, fencing, all of the capital improvements, then the closing costs. What is that cap rate after all those costs have been factored in? That's yield to cost. So on these assets that I'm focusing on is a 7.5 to 8.5 stabilized yield to cost. And my borrowing cost is 6.5 or 6.25 as the cost of debt, fixed over 5 years. So I'm looking for a 200-point basis spread from the cost of debt to the cost or the yield on cost, the return on investment for the asset. This is the protection, especially for the downturn. If I have that spread and if rents go down, if occupancy goes down, I can still cover the debt. And if I increase rents or if I increase occupancy, that's gonna increase that spread from my cost of debt to my stabilized yield on cost. But right now, stress testing the asset, that is where the discipline of investors and operators getting skipped. So before I underwrite a deal, the first 24 months, especially in industrial, maybe multifamily is a little different, but 24 months of no rent growth. That is the pad, that is the safety. I've made mistakes myself of thinking that I could raise rents quickly and the market downturns or there's a slowdown of demand, and that is decreasing the rents or keeping them flat. So underwriting right now is conservative. Don't be optimistic. It's not about being positive. It's growth is gravy, but current rents are the foundation. So why am I making this video? Well, if you're a real estate investor, I want to share what a lot of operators or investors are doing right now and no one's talking about it. They're operating on negative leverage deals. They're buying 4, 5, 6% cap rates with debt that's 6.5 or 7%. So that means that the asset's earning less because the cost of financing is more than the yield the asset's producing. And then they're banking on growing the rents for the future. But if the market doesn't cooperate, and that's a lot of markets right now, the asset's in big trouble. So that's not investing. That's speculating with other people's money or the bank's money or speculating with their own money. So a minimum stabilized yield on cost of 8%. And I know in core markets, it's hard to find deals that cash flow day one. That's the discipline. Say you can buy a good asset at a 7.25 cap and filling up occupancy at market or below market rents within the next 6 to 12 months. That's gonna help you get to that 8% stabilized yield on cost. And when I say stabilized, meaning between 12 and 24 months, getting the asset to its occupancy projection and then getting the rents up to that fair market rent or at least between 5 or 10% below fair market rent projection. You want to have that stabilized yield on cost, meet that 200 basis point spread, and that's the discipline right now, is not sacrificing that rule. So you protect the downside because we can't bank on the growth. We can only bank on day one cash flow and actually need a buffer. So that margin of safety is critical to invest in real estate in 2026. So to sum this up, I've been in the business 20 years. I've watched investors, operators, they got rich in good markets and they lost everything in the bad ones. And the best investors who survive every cycle, they got one thing in common. They never bought a deal that only worked if things were right. They bought a deal that worked even when things went wrong. So that's the discipline, that's positive leverage, and that's the only way I'm going to deploy my capital.